Very good evening, everyone. I see Anisa Kazi on behalf of Valuation Standard Board of Institute of Chartered Accountants of India. Welcome all the participants being members of the Institute of Chartered Accountants of Nepal to the third day of an online comprehensive course on valuation and valuation standards. This course is a great initiative of Valuation Standard Boards of ICAI under the leadership of its chairman, CA Hansraj and its vice chairman, CA Priti Savla, for the benefits of all the existing and as well as aspiring registered valuers. Today we have two sessions. Our first speaker for today is CA Apeksha Kukreja on topic of overview valuation. We have a scope speaker with us for the first session, Mr. Jay Ponda. Our second speaker today is CA Harmanjit Singh on the topic of valuation standards. See, Apeksha Kukreja, she's a valuation professional and is employed as Executive Director in PwC's valuation line of service. And she is with PwC for 15 years. Apeksha ma'am is a graduate in commerce from Calcutta University and is an associate member of ICAI since 2005. And she has been a ranker in CA Inter and CA Final exams. She has also passed examinations conducted by Chartered Financial Analysts USA and Global Association of Risk Professionals USA. She focuses in areas of mergers and acquisitions, including business and equity valuations, valuation of intangible assets, and purchase price allocations, taxation and regulatory valuations, and bid advisory. She has immense experience in the valuation of complex derivatives and financial instruments and financial modeling. With this brief introduction, I request ma'am to start the session. Over to you, ma'am.
Thank you, Anisa ji. Hello, everyone. Good evening. And it is a huge pleasure to be here sharing knowledge with co-professionals from Nepal. The topic that we will cover today is overview of valuations. In the current session, we will cover the topics meaning of valuation, the different types of valuation that we carry out, premise of valuation, and purpose of valuation. Today, I am joined by CA Jay Ponda, who will be co-hosting with me. Jay, if you can do a brief introduction of yourself, please.
Sure. Good evening, everyone. Myself, Jay Ponda. I'm a chartered accountant and I've cleared my CA during the 2011. I have an overall valuation experience of close to 11 years now, and I have been with PwC as an associate director in the past 7 years. Along with Apeksha, I focus in the areas of valuation, financial modeling reviews, and the valuation is in the perspective of financial reporting, transactions, purchase price allocation. So anywhere where there is an accounting or a transaction requirement or regulatory requirement for valuation, we are giving our services in that regard. So that's the kind of experience that I have. And then I thank ICI for giving us this valuation standard boards and ICI for giving us this opportunity to present this presentation on the concepts of valuation. Thank you.
Right. With this, let us get started. Jay, can I request you to put up the presentation? Thank you. So, what is the meaning of valuation? Jay, move ahead. Now, when I say what is valuation, more often than not, I get answers like is it art? Is it science? Conjecture? Fair value? Market price? Intrinsic value? And very various other definitions of, or rather, references to the word value in whatever shape and form in our day to day lives that we come across. But really speaking, valuation is a mixture of all of this. It is a profession which finely balances the science and the art aspect and also has a huge amount of subjectivity. It is a science, like I said, art, fair value, we, market price. We hear all of these terms, right? Very often. Intrinsic worth and synergies. Synergies from acquirer's perspective or synergies expected when you create a joint venture or you do upward or downward integration across the value chain. Now, these are various words which we hear, but what is really valuation? Valuation, by its very nature, is not an exact science. And there is a very fine balancing act of managing the science aspect of valuation with the subjective analysis. And that is where a professional's judgment comes in very, very handy. This judgment which an individual may exercise in various engagements or various wherever evaluation is being carried out will depend upon facts and circumstances of the case, experience of the individual, and also the level of information available in the public domain, which will warrant the exercise of a reasonable judgment. Now, wherever the balancing of science and this subjective element, which we call art, is created, that is what valuation is. With this, we will move forward. A lot of times, we try to understand what is price. Is price the same as value? When we go to the market to purchase, say, a car, the price of the car is what is quoted by the seller, by the dealer, and does that become the value? Both these concepts are different. Price is what you pay, value is what you get. Value will be from the perspective of an individual who is acquiring or selling, and price is what is available in the public domain as an indicator of what the value could be. Let's take an example of somebody who may want to buy a immovable property. Say, for example, if I want to purchase a flat, an apartment, the price which is quoted on most of these websites, be it 99 acres or any such real estate websites, which are brokering websites essentially, the price which is quoted there, would you necessarily transact at that value? No, not really. Because there would be a negotiation element involved. There would be the intention of the buyer and seller involved, provided that it is not a forced sale or a distressed sale. It would depend upon the characteristics of the asset which has been put up for sale. An equivalent apartment in the same building but on a higher floor will have a higher price. But will you pay a higher value for that? Depends upon your negotiation skills as a buyer, and also on the other side, how keen the seller is to make that sale. So, market value is price. Market value is what a knowledgeable, willing, unpressured buyer would be willing to pay an equally knowledgeable, willing, and unpressured seller in the market. Whereas value is what you believe, the benefit that you would draw from the asset. So, value is based on the underlying perception of true value. If I were to link it to an accounting concept, I would say that intrinsic value is more driven from the cash flows expected to be generated from an asset, or the cost savings expected to be made due to ownership of that particular asset. That is the intrinsic value, what the true worth of it is in your eyes when you are looking at acquiring a particular asset. So price and value are different. Price is what you're willing to pay, value is what you expect to get out of it. Market value, uh, again I go back to our accounting experience, where there are different levels of value. Level 1 being most observable prices, level 2 being based on comparisons in the market of assets similar to the one that we are looking to value, and level 3 is where the valuation inputs are unobservable, like in case of a DCF, a discounted cash flow. Market value will be the highest in terms of priority, that what you are willing to pay, the price which is prevailing in the market. But the value can be very different. The value from the perspective of a person acquiring a company based on which he's expecting to do a backward integration into the value chain will be more as compared to any other market participant, primarily because the true worth of making that acquisition for this company which is looking at an backward integration is the cost saving and reduction in its existing costs because of this acquisition that it will make. These synergies, which may not be available to other market participants, is reflective of the true value of that asset or that company which the acquirer will enjoy. So, on the onset, when we discuss valuation and we hear all these terminologies like market value, intrinsic value, fair value, please know that price and value are different. Price is what you are willing to pay, value is what you are getting in return. It is to say, value is lies in the eyes of the beholder. Right. With this, may I request Jay to present the next section? Bear with me, Jay. I will put up my screen. Is my screen visible?
Yeah.
Over to you, Jay.
Thanks, Apesha, for setting the context. The next section of the valuation that we want to discuss is what are the bases of valuation. The basis of valuation is an indication of the type of value which you will use in any engagement or any transaction. Different bases of valuation will lead to different conclusions. So, selecting the right base of valuation based on the requirement of valuation or what kind of reasons why the valuation is carried out is very important. There are three broad categories of valuation bases. The first one is fair value, which we all commonly know. Second is the participant specific value, and the third is the liquidation value. Let's talk about each of these valuation bases in a little more detail. Fair value. Fair value is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the valuation date. This is something which we have heard, we have kind of practiced on a recurring basis whenever we are doing valuations. Let's now understand each of the subsegments within the fair value or each of the notes within the fair value definition. So, fair value is the price. What is the price in fair value? Price is a price which is negotiated in a free market. That market could be domestic or international. We also look at the characteristics of an asset which are available to market participants. The market should be the most advantageous market. The asset should be within the highest and best use. That use should be physically possible, legally permissible, and financially permissible. So, whenever we look at price, it should factor all these characteristics as well. Being one is free market, the second is characteristics of an asset which is available to any market participant. The most advantageous market should be considered in case if the asset is used in a manner which is not the most advantageous, but while we are doing a fair valuation, we should consider the most advantageous market, and that advantageous market, the use of assets should be physically possible, legally permissible, and financially permissible. Further, this pricing should be determined from a perspective of a market participant, even in case if the entity intends to use that asset in a different way. Entity or the owner of the asset intends to use it in a different way. Say, for example, there is an FMCG company who has two brands. One brand is into snacks, one brand is into nutrition food. The business of nutrition food is relatively low, but the business of snacks is very, very voluminous. So the entity kind of intentionally tries to downplay the nutrition brand or nutrition market in such a way that the overall food and snacks market and the overall food and snack brands grows well. So that is the company not using the nutrition brand in the most optimum way is something which is not a market participant view. It's how this entity is using it for the way it wants to do the business to kind of an overall growth basis. However, when we are valuing only the nutrition bar business or the nutrition stack basis, we should consider what would be the growth of the nutrition business independent of how the company is trying to use this. uh, the second part of the fair value, once we have discussed the price, the second part of the definition is an orderly transaction. The price which should be received to sell an asset or paid to transfer a liability in an orderly transaction. What is an orderly transaction? Orderly transaction assumes exposure to the market for a period before the valuation date to allow for marketing activities that are usually possible. So whenever you're using or trying to do any asset valuation or a business valuation, and then the definition or the premise under which you're doing is fair value, it potentially considers that you will be able to kind of negotiate, get into bids, have term sheets, do certain activities which are required in the normal course of business for you to sell the asset. So that is the price that you would get in an orderly transaction between market participants at the valuation date. Now, the third and the fourth points within the fair value is market participants and valuation date. Now, what are market participants? As we discussed earlier in the definition of value, market participants are willing buyers and willing sellers. Along with willing buyers and willing sellers, they are knowledgeable and they are allowed or they are able and willing to enter the transaction. What is the valuation date? That is a date of valuation. This is a time specific criteria because generally the market parameters, the risk free rate, or any other manners in which you do valuation changes within a period of time. So defining the valuation date also becomes critical when you do a fair value. So four key components of fair value is price in a negotiated free market. Market participant you is it's a broad framework under which it should work. It should be in an orderly transaction between market participants as at a specific valuation date. So these are broad conjectures under which a fair value is undertaken. There are different categories of fair value and the fair value requirements for different kinds of requirement, be it regulatory, be it SEBI, be it accounting. The way we undertake fair value changes a little bit, which we'll discuss in the next slide. But this is the broad first valuation base, which is fair value. The second valuation base,
Jay, if I can interject over here, I
sure,
think fair value is the most commonly observed valuation engagement which a valuation professional comes across. Because of the advent of Ind AS and popularity of IFRS and US GAAP, fair valuation has become the premise of financial reporting. A lot of times regulatory requirements are there which govern determination of fair value for transactions from either an income tax point of view or from foreign exchange management act point of view. So more often than not, I would think that a valuation professional will be carrying out engagements of fair valuation more than anything else.
correct. Going on to the next valuation base, which is the participant specific value. So fair value, when I say it's from a market participant basis, participant specific value, as the name suggests, is the value of an asset for a specific participant or categories or buckets of participant. We'll first go to the definition and maybe then I'll try to give you more examples on participant specific value. Participant specific value is the estimated value of an asset or liability considering specific advantages or disadvantages of either of the owner or an identified acquirer or identified participants. So the definition itself is kind of explaining what does participant specific value means. Let's give a few examples of participant specific value. Say a acquirer is acquiring a company which has huge brought forward losses. Once they merge this company, or that acquirer is trying to kind of look at this company for potentially merging this, and the plan is to kind of utilize the brought forward losses along with the profits of the acquiring company. So the potential benefit which the acquirer has, because of the ability to utilize the losses of the target on a fast track basis or on an early basis, is the benefit available to a specific participant, and hence the potential incremental value or the potential benefit of this utilization is specific to a participant. So while in normal course, the fair valuation, if would be done, the target would kind of, we'll try to look at how will the target perform in terms of profitability, whether in terms of that profitability, how we will utilize the losses which this target has generated in the past. But from a participant perspective, that ability to utilize this losses immediately is the extra benefit which the participant would get, and hence that valuation specific to this, or the valuation carried out specific for this regard, will be a participant specific value. Let's look at one more example. A real estate company which owns two or three hotels over here in a specific location is trying to kind of acquire a land which is just beside this hotel for refreshment purpose, or for creating a sports complex for the members of the hospital or the members of the hotel. Now the potential value which this hotel feels for this land, just because of the ability to charge the premium pricing when this land gets converted into a sports club, or it can be converted into a banquet, so that the members of the hotels or the clients of the hotel can use this complex. That potential incremental value is specific to only this specific hotel, because they have this adjacent hotel beside this land. So the potential projections done, or the kind of workings done just to create what kind of value which the acquirer would get in case if they are able to buy this land, is specific to only this specific acquirer, and hence even any kind of valuation done on this premise also becomes participant specific value. uh, Now we move on to the third value, which is the liquidation value. Liquidation value is the amount that will be realized on sale of an asset or a group of assets when actual hypothetical termination of the business is contemplated or assumed. So as the name suggests, in case if there is a business or an asset which cannot be put to good use, and potentially there are, say, stressed asset scenarios, the bank is, there are outstanding debts which are not being cleared, and potentially the best possible outcome which one feels is to liquidate the business, or sell off this asset, and whatever is the amount realized by selling this asset on an as is basis will be the liquidation value. Now, liquidation value has also two subsegments within liquidation value. One is an orderly liquidation value, and one is a post liquidation value. Let's talk about two examples, or one or two examples for both of this. What is an orderly liquidation value? Say, for example, there is a factory which is doing a pharmaceutical business. That factory has been incurring losses because of the way they are doing business. The products are not acceptable in the market, and hence there are lenders which remains unpaid. Under an IBC proceeding, the call which has been taken is, let's liquidate this factory. Once you start liquidating this factory, there is a potential middle party which gets appointed, and they will run the process. This party will invite bids, try to kind of get 8-10 bids, and then give the factory to the most optimum, or the person who has given the highest bid. So this is the liquidation value, where the normal process of a liquidation is followed in terms of potential of selling, marketing, going to the market, and then kind of giving this factory or selling this factory to maybe a third party. So this is called an orderly liquidation, where potentially there are bids, you could do certain activities to get the value liquid, to get the liquidation value. What is the forced liquidation value? Forced liquidation value is completely opposite of this. Using the same example, in case if there's a factory, and potentially there is no bidders over here, and potentially the business is not only from the person who was running the business, but even for someone who will kind of try to take it over, there is no value, and then the call which is taken is just scrap off the assets, or just sell off the assets the immediately in whatever price which is available. So this is the value where relatively the outcome of the valuation will be lower than orderly liquidation, but the number, or the absolute amount of this liquidation value, which is a forced liquidation value, will be lower than orderly. So this is the two categories. One is orderly liquidation value, and the second is forced liquidation value. I'll just take a pause over here. I've kind of covered the three broad premises or broad valuation basis, which is fair value, participant specific value, and liquidation value. Apeksha, would you want to add anything on this valuation basis?
No, Jay, I think this is a good explanation. Let's continue. We can take questions right at the end.
Okay, we'll move on to the next slide.
Yeah, please.
Now we come to basis of value. Now the earlier side was valuation basis. The current slide is basis of value. Let's try to connect both the slides. The basis of value, the key primary base of value is the fair value. Now fair value for different regulations, different requirements are different. The way we do the fair market valuation, the calculations there too also will be different. So let's talk about potential differences, which all of this will still be fair market value or fair value, but under different requirements and circumstances, the outcome will be different. The first and the foremost, which is the fair market value and the market value in general. So if you're doing like a business valuation in general, you would look at projections, you would look at DCF, you would look at comparable companies multiple, uh, look at transaction multiple, and come to a fair market value. Now in case of, let's say we give, let's try to take an example. Assuming that company A buys company B, and the stake of the company acquired is 15%, 51%. So this is kind of a majority transaction, and say the company B is listed on the stock market. In case if the company B is listed on the stock market, you have the share prices which are visible in the market as well. That is also like a fair value. The market price of the company which is listed, in case if the company is frequently traded, also gives you an indicator of fair value. But because the company A is acquiring company B and the stake acquired is a majority transaction, uh, potentially company B has negotiated, or the company A has paid an additional control premium to acquire this controlling stake. So the price which the company A is paying to company B is also a fair value, but that is something which is a price or a fair value from the perspective of an M&A transaction. uh, in similar example, say company A is acquiring company B, there is a tax valuation requirement also. There is a 50 CA for a seller purpose, 56 to 10 for buyer purpose, and the valuation requirements in this guidelines, while the definition is still fair value, but this income tax regulation specifies a rule 11 UA NAV formula under which the valuation has to be carried out. So in case if I have to kind of just do a quick summary, the valuation methodology is you take the land, you take the building, you the stamp duty valuation of the land and building. In case if there are artifacts, do the fair valuation, and then come to an NAV, which is divided by number of shares to come to a value per share. So that is also fair value, but that fair value is for tax purpose. Now we look at the fair valuation under accounting purpose. Uh, let's try to give an example over here for a acquisition which the company has already completed. Company A has acquired company B, and once the company A has acquired company B, from a consolidation perspective, company A will have to undertake a purchase price allocation. So whatever is the purchase consideration which company A has paid, that will be allocated between identifiable assets and liabilities, and the balancing number will be goodwill. So this process of doing a PPA, where identifiable assets will also include assets in the books, but other intangible assets such as say brand, customer relationship, distribution network, and then we'll try to kind of value each of this separately using methodologies which are prescribed for doing intangibles valuation. And then whatever is the balancing number when we compare the purchase consideration with the whole list of assets and liabilities valued for intangible, the balancing number is goodwill. So this is a fair value which is again done using the same premises, but this is like an accounting requirement of fair value. In a similar example, say company A was family owned. There were two brothers and sisters who run the company, and there is a family settlement of company A which has been specifically kind of legally drafted in a way that in case if the brothers and sisters are selling stake, they will have to do the valuation or give exit to the second party using say a formula of valuation, say 4x of revenue or 10 times of EBITDA multiple. That is something which is already defined in the legal document. So even that will be fair value, but that is fair value under maybe a legally specified clauses. So that fair value is only specific. It's kind of a participant specific value which we kind of covered in the earlier slide. So this value is only for a specific participant, but not be no, but would not be the case for all any market participant, acquirer or buyer. Let's
Jay,
look.
another example to this situation would be where, say, for example, if two parties have formed a joint venture, and or in case of a business combination where say company X acquires say 51% in company Y, and the non-controlling interest shareholders are eligible to sell the remaining 49% shares to company X after say 2 years on achievement of certain targets. In that case, the company X, which is the acquirer, is required to recognize the liability in its consolidated financial statements, even if there is an optionality with the non controlling shareholder whether to sell the remaining 49% or not. In that case, the assessment of liability in books of company X will be determined as to how the consideration is defined in the agreement. It could be like in your example, you said 4x of revenue or 10x of EBITDA. It could be a similar definition based on targets of a particular year, and the assessment of the liability that will eventually be payable by X to the non controlling shareholders of Y will be determined based on the formula which is specified in this agreement. So wherever there is a legal element involved, wherever certain formulae have been drafted into the agreement, those have to be considered when fair valuing any, say like in this case for company X, if the contingent if the deferred or the contingent consideration liability is to be valued, then the contours of the formula mentioned in the share sale agreement have to be considered.
Correct. So, moving on further, while we discuss the tax requirement of fair value, the normal general fair market value requirement, the M&A, the accounting, the legal, the two maybe couple of other examples which we can give is value in use calculation, or the fair value under the value in use requirement, which is required for impairment purpose. Continuing the same example, let's say company A acquired company B, and pursuant to doing a purchase price allocation, there has been goodwill which has been recognized in the books of company A pursuant to this transaction. Now, the accounting requirement says that this goodwill will have to be tested for impairment every year. And when we do impairment testing for goodwill, there are guidelines under Ind AS 36 which says you can use a value in use concept, or you can use fair value less cost of disposal. When you use a value and use framework, the accounting requirement says you cannot consider restructuring, you cannot consider expansion plans which the company is planning to, and try to value the company the way it has been acquired. You can consider potential market improvements or certain generic price inflation, but the requirements is very specific in terms of not taking expansion plans into consideration, not considering any potential benefits which would be available in case if the company B is restructured. So the framework of fair value which is then required under this value in use is different from the fair market value which could have been considered for an M&A transaction or for a tax purpose. One more example, maybe this is a definition per se from an economic value perspective, is uh, that economic value is again kind of trying to connect it with a participant specific value, is a value which is available only to a potential specific participant. So the economic value for in the example which I gave earlier, in case if I have an hotel and I'm trying to acquire the land which is beside, the economic value for me as the owner of the hotel is very very different from any other person who is looking at the land. That economic value is something which, for me, when I want to go into negotiations and then will try to acquire this land, in my mind, that all benefits of potentially using this land along with the hotel, adding more value because of me being able to service the clients in a better way, all of this gets factored in the economic value concept because that potential benefit is only available to me. So these are the different bases of value or the bases of fair value which are generally carried out for various transactions, regulatory, accounting, impairment, decision making perspective. Once we have the basis of value, I'll just very quickly take on the next slide, which talks about generic definitions which are there in the accounting literature. Apeksha, requesting you if you could move on to the next slide. So, what are the various definitions of value? As per Ind AS 113, the fair value measurement, fair value is defined as the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date slash valuation date. So, that's something which we discussed when we covered the fair value valuation base. There are fair value definition also under OECD guidelines. The OECD guideline defines fair market value as the price a willing buyer would pay a willing seller in a transaction on the open market. The framework, the understanding, the thought process of this definition is similar to the fair value definition. However, the income tax definition, the fair market value, is defined as per the income tax rule, either a formula prescribed in applicable rule or the price which such asset would fetch if sold in an open market on the valuation date. Under various regulation of income tax, in certain sections, the formula prescribed gets triggered, which is the rule 11 UA formula. That formula, as we discussed earlier, has methodology in terms of how you compute stamp duty valuations, arrive at an anyway. And in case if the 11 UA is not applicable, the definition is what would be the price of an asset if sold in an open market on the valuation date. So in case if this part of the formula gets triggered, the general thought process is you can use acceptable, internationally acceptable methodologies such as DCF, CCM, ETM to do the valuation. So these are the broad key definitions of fair value under accounting and tax guidelines, which are generally oftenly used while doing valuation engagements. We'll move on to the next slide. Connecting to the basis of valuation. Now let's move on to the premise of valuation. All of the basis and the premise to valuation is kind of connected. You select the right basis of valuation and automatically the right premise of valuation gets linked to it. So the premise of value refers to the conditions and circumstances how an asset is deployed. In a given set of circumstances, a single premise of value may be adopted, while in some situation, multiple premise of value may be adopted. 4 5 key premise of valuation is the highest and best use, going concern value, as is where is value, orderly liquidation, and forced liquidation. Let's look at each of this premise of value very quickly. The highest and best use is the general definition which is there in the fair market value. Whenever you're trying to value any business, potentially, even in case if the asset is being used differently, you try to kind of look at the asset from a market participant view and try to see what could be the value of that asset in case if it is put to the best possible use it can give. And once you use or you kind of have that assumption in mind in terms of the highest and best use, one thing which you should kind of also cross check is that highest and the best use should be legally and regulatory permissible. In case if it's a agricultural land, that potential of being converted into commercial property is something which is the highest and best use, but there should be that regulatory allowability that that land can be converted to the non-agricultural land and then property can be developed. So the legal permissibility, financial permissibility of the highest and best use should be also looked along with it. Going concern value, again, when you look at the fair value, potentially the value of the business or an asset that it will continue doing operations the way it is or in the highest and best use manner is something which also have to be the premise of valuation when you do a fair market value. Uh, when you are doing a liquidation value, we spoke about these terms in the previous slide. What is an orderly liquidation? What is a forced transaction? Orderly liquidation, in case if you are selling an asset, you are having enough time to kind of get bids from various bidders, do a normal process, negotiate, and then sell an asset. So while the premise of value, the basis of value is the liquidation value, and the premise of value under which the liquidation value is carried out is an orderly liquidation. In similar cases, in case if the expectation is we need to exit the asset and get whatever value we get out of the asset in immediate period without doing any marketing, without whatever is the bidder available, just get the price, that's the liquidation value under a forced transaction. And one of the other premise of value is an as is where is value, where we kind of try to value the asset the way it is used currently. While the highest and best use is possible or a potential maximization of that asset utilization is possible in a different way, but in case if the premise of the value is just see how the asset is used currently and try to see what cash flows can be earned from it or what is the benefit from the usage of the asset and the way it is being operated currently, that is an as is where is value basis. So that are the key conjunctors of the premise of value. One is the highest and best use and going concern, which is looked together when you do a fair market value. As is where is value, we can connect it to the participant specific value requirement, and orderly liquidation and forced transaction can be connected to the liquidation base. So these are the key premise of value. With this, I'll hand over the slides to Apeksha for taking the 4 5 next upcoming slides.
Jay, may I request you
Sure.
to share the screen, please? Now, we have understood what is valuation, what are the bases of valuation, and what is the premise of valuation. Now, let us see what can be valued. Well, I always like to say, that we can value everything under the sun except human capital. Now, why do I say that? Let's evaluate. Broadly, what can be valued can be classified into four buckets: tangible assets, intangible assets, financial instruments, and most often business and equity. In the tangible assets, you have land, building, plant and equipment, inventory. It could be, plant and equipment, machinery, very specialized equipment. And tangible assets are more often than not encountered in situations where, say, a company wants to borrow from a lender, and the lender may have asked for a collateral. For the valuation of the collateral, the assessment of the cover that the lender will get by virtue of having these assets as their collateral is one of the reasons why tangible assets can be valued. The other is, Jay spoke about a liquidation scenario where the company which is being valued is not a going concern, is has incurred significant losses and may be in the liquidation process. In that situation, uh, what is the value that one can get by selling that company? It will not be valuation and a going concern because there is no ongoing business. In that case, the value will be the piecemeal value of all the tangible assets put together, be it plant and equipment, land and building, inventory, or any other form of tangible asset. The other scenario where I can where we often encounter valuation of tangible assets is in a purchase price allocation. Ind AS 103 requires in a business combination for an acquirer to allocate the consideration paid for the target company to be bifurcated into fair value of tangible and intangible assets and these values to be recorded in the financial statements of the acquirer. Over here, the book value of the tangible assets cannot be considered because that is not the accounting requirement. More often than not, the fair value of the tangible assets will be carried out and will be the basis of the depreciation going forward after the acquisition is complete. So you will see valuation of tangible assets both in a pre-deal scenario and in a post-deal scenario. In a post-deal scenario, more often than not for financial reporting purposes under the requirements of India's 103. In the pre-deal scenario, like I said, if a company wants to borrow and give collateral, that is one scenario. The other is, say, an acquirer wants to purchase a company, but what should it pay for it? Very often, while the going concern concept is very important, the acquirer may want to assess that what is the value of the tangible assets which it will acquire. It becomes a base value. He would be very sure that the value that he will pay to the seller has to be more than the net asset value determined basis the tangible assets, because the earning potential of the company is not captured here, and this is the very base, the very minimum that he would have to offer to the seller. Let's look at business and equity. Now, the this really does not require an introduction, because the very basis, 95% of the instances where a valuation engagement is carried out, the subject matter is either valuation of a business or valuation of an equity. The equity can take form of any class of equity. Like these days we come across class A, class B, or class C shares, which may be defined in agreements to have different voting rights, different economic benefits attached to them, and can also take the form of preference shares, which may convert into certain classes of equity. Also, business enterprise valuation may be required, one for a decision making purpose to enable a merger and acquisition situation, or say if a project is to be funded, how does one determine the leverage? What is the extent of leverage that a project owner would want to fund, and how much would they want to borrow? These kind of capital allocation decisions can also be made by basing them on business enterprise valuations. Then let's go diagonal and look at intangible assets. Now, intangible assets can be in any shape and form. They are typically not recognized in the balance sheet of a company. So, does it mean that they do that such intangibles don't have a value? Actually, no. It depends upon the industry in which a company is operating. If a company is operating in a space like retail, for example, the brand has a huge value recall. Or if a company is operating, say, in a FMCG space, then the distribution network is very, very important. Say, if a company is operating in a consulting space, then a non compete agreement becomes paramount importance. In case of a pharma industry, the patent or the formula, the copyrights around that become very, very important. So, intangibles have definitely a role to play in the business valuation. The value of a business, if we look at it from a funding perspective, it is the value of fair value of equity plus fair value of borrowings. And if we look at it from the asset side, the value of a business is value of tangible assets plus value of intangible assets. Now, more often than not, you would come across a situation of where intangible assets are to be valued, where is it required? More often than not, it is required for purchase price allocations, where, like I mentioned before, Indias requires an acquirer to split the purchase consideration into various tangible and intangible assets and to record them at fair value in its financial statements. This is one instance where valuation of an intangible is required. The other would be impairment assessment. For indefinitely lived intangible assets, say a brand like Colgate or Pepsi, which has been in existence for we don't know how many years and is expected to continue going forward for infinite number of years. In those situations, intangible assets will have to be tested for impairment every reporting date. The third instance which comes to my mind is when a company may want to borrow and again offers intangible assets as a collateral. Now, collateral typically may not be an intangible asset. In most of the cases where collateral is taken, you would come across situations where equity of the target company may be collateralized, or tangible assets may be given, or even working capital items like debt and inventory may be put as a collateral. But sometimes when the brand is very strong, or say the formula with which a pharmaceutical company is producing a product is very niche and of immense value, in those situations the intangible assets can also be given as a collateral. The third situation where an intangible asset may be required to be valued is where the subject of the transaction is the intangible itself. You would come across sometimes in the newspaper that a pharmaceutical company has acquired certain brands, underwriting formulae, and distribution network pertaining to those brands from another pharma company. In that case, the valuation of this transaction would be driven by the valuation of the intangible assets. Some interesting intangible assets like non-compete agreements. There will be very far and few, almost negligible instances of active market for intangible assets. But are these assets in the legal parlance of or as per customs of market? Yes, they are. Whether a value can be ascribed to them? Yes, there are scientific methods which are used to value intangible assets. And are these legally tenable? Most of them are legally tenable. The protection provided to a brand owner, if the benefit of ownership is demonstrated, will definitely result in him legally owning that brand and not having anyone else encroach on or have a parallel or a similar sounding brand name. An agreement like non-compete agreement, these are tenable in court of law. Copyrights are also legally tenable. So intangible assets, although not very actively traded, but very form very integral part of transactions and can be the basis on which a transaction has been undertaken. Let me take the example of workforce. A lot of times workforce, in fact most of the times workforce cannot be recognized as an intangible asset because it does not meet the definition of intangible asset as per accounting standards. But many times the transaction may be undertaken to acquire the workforce. Say an IT company is acquiring another IT company, which may be extremely small and may not own a very significant business or have very BT contracts, but the service offered by it, primarily based on the talent it holds, is very niche. In that case, the entire premise of the transaction or the reason for entering that transaction is the workforce. So while intangibles may not be actively traded, you may not come across such instances very often, but definitely hold value. I will come to the last tranche, which is financial instruments. Now, financial instruments, the Indian markets so far have not the depth to value finance, to frequently encounter financial instruments. It is only in the recent 5 years that we have seen traction pick up for financial instruments like options, warrants, and swaps. These options can have an underlying like foreign exchange, like equity, commodity, and the futures and forwards may also have similar underlyings. Some of these can be listed and traded on the stock exchange. Some of these may not and may form part of agreements between, say, a bank and a company, or between two banks or two corporates. Now, valuation of these financial instruments is complicated. Uh, it most often there are statistical models which are used to carry out valuation of financial instruments. Uh, but you will actively find that in transactions, in business combinations, there will be instances where the where certain part of consideration may be given in the form of an option. I spoke about an example where X acquires a company called Y, and the non-controlling interest holders may have a right to sell the balance 49% at a predetermined formula pricing. That is nothing but a put option where the seller has written a the company X, which is the acquirer, has written a put option to buy the shares of the non controlling interest shareholders after a period of time based on a predetermined formula. So, this largely covers the premise of what can be valued. Now, we will move on to see how is the valuation carried out. I will not spend much time on this slide because this is your third day of the program, and some of this may already have been covered or will be covered in the next sessions. But the three most commonly adopted valuation methods are the income method, most commonly of which is the discounted cash flows, the market approach, where a comparable market transaction or a comparable company, the parameters of a comparable company are used to value or apply to the subject company for its valuation, or the net asset approach. The net asset approach is the least number of times adopted approach, primarily because it does not capture the going concern concept or the earning potential of a business or a company, uh, and may not represent be representative of its earning potential. There will be very specific instances where a net asset approach can be adopted, and those would be typically in a liquidation scenario or valuation of holding or investment company, where the holdco may derive the value from underlying assets or investments. Whichever method a valuer adopts, there will always be triangulation of value. It cannot so happen that the value under a DCF, say for the sake of example, is 100, and under the comparable market method is 50, and under the NAV I will not utilize really because it doesn't capture the going concern. But a 100 under the DCF and a 50 under the market approach, these are too wide, and this gap needs to be bridged. If a valuer comes across such an instance, they have to go back to the drawing board to assess which method is not giving out an appropriate outcome. A difference of maybe 10 to 15% in the valuation under two methods is still acceptable. But anything beyond that, the valuer definitely needs to reassess. And that is why triangulation of value is one of the most critical steps which a valuer has to adopt. Jay, can we go to the next slide, please? Now let's look at levels of value. The reason of me touching upon the methods earlier in the previous slide was to set context about this slide, where the uh, the premise from with which the valuation is being carried out determines the level of value which the owner will have. So, suppose somebody is looking at acquiring a company from a control perspective, or or rather, let me start with decision making, strategic decision making. The company which is being acquired has a strategic value for the acquirer. It could be either a backward or a forward integration for the company where the target is sitting in the value chain. In that case, the acquirer may be willing to pay a premium to acquire the target company. So, say for example, if we look at a company which manufactures glass fiber products, and it has and in that case glass fiber is a raw material which this company purchases. Say it comes across a situation where a target is available in the market, where whose promoters are willing to sell, and that company manufactures glass fiber as an output, which our company uses as an input. Now, this is a backward integration, and to make acquisition of this glass fiber manufacturing company, the glass fiber components manufacturer company would actually pay a premium, because it will get a synergy, it will get a benefit which any other player may or may not be able to derive, primarily because of the value chain that it is, where it is, its ecosystem is located, and the benefit a backward integration will result in. This value will typically get captured in the DCF, because the synergies which arise may not be reflected in the market multiples available in the public domain. This also coincides with the control over cash flows. If it is a control transaction where the stake being acquired is of control, and when I say control, I do not mean acquisition of 51% of equity. I mean any position which gives you, as an acquirer, control of the operating cash flows of the company, the ability to decide its future course of action, the ability to control the board, the ability to influence the voting process. If that sort of a stake is being acquired, even if it is a significant minority, the value which results is determined by a DCF or a transaction multiple value, and will be higher than the market multiples prevailing for comparable companies. If one is to look at only comparable company multiples for a valuation, it is a minority valuation, because the multiples implied by minority lot transactions, which typically take place in the market, do not reflect the benefit arising because of the arising due to the ability to determine the future course of action or the control aspect of it. That is why, from a value chain, uh, if we have a market multiple, you would have a control premium over it. And if the acquirer has the benefit of forward or backward integration, there would be a strategic premium payable over and above it. So the level of value that we are speaking about is on the left hand side, and the applicable multiple or the method is on the right hand side. Now, if our starting point is the comparable companies approach, in that case, the company which we are valuing, if it is unlisted and there is no active transaction about which you are aware as a valuer, then you will apply a marketability discount. This is the discount to factor in the fact that the company which you are valuing is not marketable, and there is no active market for it, there is no liquidity, and hence it needs to be applied. These different concepts are important to understand, because this will depend upon the level of value on the left hand side, and the methods adopted on the right hand side are influenced by the middle column, which is largely influenced by the purpose of valuation. That is why it is important to look at it in this three columnar holistic approach, because the level of value is influenced by the purpose of value, and the purpose of value will influence the valuation method. Jay, can we move on to the next one, please? Now, demand for valuation and key considerations. This slide and the next one talks about various opportunities under which a valuation engagement may arise. Largely, this is the purpose of valuation as to why a valuation is required. Some of the instances where a valuation can be required, and this will largely be most of the instances, like accounting, impairment assessment, purchase price allocation, fair valuation of shares and share options for financial reporting. Then there are regulations in the taxation, in income tax, which require a fair valuation. Some of these sections would be section 50B, 50CA, 56210, determined by rule UAAE, where rules have been set out as to how fair market value is defined under each section, and what is the prescribed method to be adopted for carrying out that valuation only in context of income tax, only to determine the tax incidence, or to evaluate if a tax incidence really does arise. Then there will be transactions on the stock exchange like open offer, delisting, or takeover code, where valuations may be required. Restructuring, this is an internal exercise where a company may want to restructure its operations or move operations within different geographies, and hence a valuation may be required. Investment appraisal, these decisions are typically made by corporates or by private equity, where capital allocation may be the ask. And portfolio valuations, these are typically required by holding companies or by private equity, which have the obligation, one, to record their investments at fair value, and two, to report to their investors about the fair valuation of the investee companies. Some of the rare cases which one may come across as to why a valuation may be required, these would be dispute and litigation. Dispute, say a family settlement, or it could be a JV split, or a litigation based upon different uh, different expectations of value from a business, where the two JV parties or acquirer and seller may have different points of view. But in these situations, a pre existing relationship has to exist. Either it could be a family situation, or it could be a joint venture, or it could be a situation of breach between a buyer and a seller. In most of these cases, the key consideration that one has to bear in mind as a valuer is, what is the subject matter of valuation? What are the key drivers? Business risk, economic rates, status of the industry, status of the larger macroeconomics prevailing in the country and globally. What is the valuation date? Any market parameters or valuation parameters or industry dynamics after the valuation date should not be considered. The benefit of hindsight is not available in most of the valuation engagements. What is the basis of value? We have spoken at length about this. Is it fair value, liquidation? This is very important. Stakeholders. Who are the stakeholders? So, say in a JV split, who are you assisting? Are you assisting the Indian seller, or are you supporting the, or are you advising the foreign party? The are you on the buy side or sell side? These kind of considerations will impact how you carry out the valuation. A buyer would want to pay as low as possible, whereas a seller may have a different expectation of sale price. One may want to, have the best highest sale price possible, and the other one may want to pay at the lowest possible of value that is defendable. In some industries, a specialist expertise may be required. Say in the commodities market, a business which sees different business cycles, particularly in today's macroeconomic dynamics, which is fractured by geopolitical situations, lack of trust, onshoring and offshoring situations, various wars going on, and the volatility resulting in, say, oil prices, gold prices. In this sort of a situation, how does one predict at what stage of the business cycle is a commodity player? In that situation, you may require a specialist, an industry expert. Or it could be, say, a very niche segment where industry expert has to step in. Say in case of a pharma company producing one of the rarest drugs possible, and say if the ask from your client is to value the underlying formula, an expert opinion may be sought to determine the feasibility of such a product going forward, past experience of similar products, or if not similar products, how new products have performed in the market before this. This sort of expertise may be required to make an assessment of your own target company's business and value. Most important, the information available. Now, when I say information available, I do not mean only the information with the management, but also what you find in the public domain. Public domain can comprise of paid subscriptions, business journals, databases, general secondary research, our internet, all that can reasonably be expected to be availed, what a valuer can easily or reasonably be expected to access. All of that information should be considered in all your valuation engagements. Now, appropriate method depends upon facts and circumstances. It depends upon the nature of industry in which the company is, the stage of its operations, the size, availability of reasonable level of information, availability of the management for discussion. So, appropriate method will depend upon these factors. The level of review required. If it's a very niche, like if I go back to the example of a commodity business where a specialist expertise may be required, in that case, what is the level of review that a valuer would give to the inputs which have come in from the specialist? Or say the engagement requires tangible asset valuation, but the valuer may not be able to do that and may have outsourced that to an expert for tangible asset valuation. The level of review required on the expert's work is a matter of consideration. And then, of course, the fees and recovery. This is the commercial aspect which most professionals are aware of. Jay, we move on to the next one. The different kinds of scope of work that we typically encounter, we have just classified this into three buckets: transaction, regulatory, and accounting. This slide is very, very straightforward and self speaking because we have spoken about each of these instances in the past few minutes. Transaction related bucket comprises of all the valuations which are required for decision making in a transaction, like mergers, acquisitions, restructuring, fundraise. Regulatory valuations are required under different regulations prevailing in our country, and this is particularly from an India standpoint, where you may have similar regulations in your geography, like the Companies Act, the respective income tax act of each country, or foreign exchange, or any valuation required by the stock exchange regulator. And accounting wise, impairment, purchase price allocation, fair valuation for reporting purposes, ESOP valuations. So this essentially covers the entire spectrum of deal making, where where transaction bucket pertains to an active live deal. The regulatory aspect covers, in the case of a live deal, what are the compliances, valuation required under compliances to be done when the deal is ongoing. And the accounting piece is the post deal spectrum, where one still has to cover all of this because it has arisen either from a deal and now needs to be fair valued, recorded, and reported, or subsequently when there is a requirement for impairment assessment. With this, we cover the premise, basis, and purpose of valuation. We are open to questions. I request the moderator to let me know any questions which may have come in.
Yes, ma'am. Just 1 second. Refer to the questions. The first question is, in what ways do market comparables play a role in the valuation of businesses?
Jay, would you want to
Sure.
attempt that?
Sure. So I think the methodologies of valuation where we discuss CCM, the purpose of valuation. So the way other market comparable companies, the way they are behaving in terms of what is the PE ratio at which a hospital company is trading, or what is an EV/EBITDA ratio at which a particular company or a particular sector is trading, that will give a basis or a kind of framework under which the target company which is getting valued can be evaluated. So there are let's look at NBFCs or banking sectors. They are trading, or the good banking companies which less NPAs, good growth stories, are trading somewhere at around 1.1 to 1.8 times book value. So somewhere that gives a basis or a genesis in terms of, okay, so in case of a good banking less NPA company is trading at a 2x book value multiple, you try to then look at your company, what is your growth story, what is your NPA position, what are other banking ratios of your company vis-a-vis the comparable companies, and then try to do company specific adjustments to arrive at the potential price to book value company multiple which your company can get. So the valuation, the way I would like to conclude it is saying that the comparable companies multiple give you a starting genesis or a starting base point in terms of, okay, this is the starting point at which your company can start getting a valuation plus minus company specific adjustments which may be required.
Okay. How do economic conditions and market trends impact the valuation of assets or companies? So I think this madam
Actually,
has already discussed.
Anisa ji, this is a very
Already,
important
yes.
aspect. This is most definitely an important aspect because how the macroeconomic. So let me start from the global perspective. How the global markets are performing. And when I say markets, I don't just mean the stock markets, it's the global economy performance, which come down to the country's performance. And from the country's performance, it comes down to the industry performance and then performance of individual players.
Right.
It all has a trickling effect. See, the most classic case is of today's situation, where we know how the global economies are looking. The growth rate for the growth rate as per IMF for the global economy to grow is less than 1%. But in spite of that, India's most of the rating agencies have recently revised India's growth expectation from and ranging from 6.5% to 7%, depending upon the performance of the country in the second quarter of FY24. Within that, there are some sectors which are performing better than others. And within that, there are some high growth companies and some matured players. But how the overall global economy impacts India, particularly aspects like exports, and hence impact on manufacturing, and hence impact on any company operating in the manufacturing sector. All of this cannot be wished away. Any sort of projections which a company is preparing has to take into consideration all of these
Right.
aspects.
Yes. Right. Yes,
Let
ma'am.
me just
I
give
agree.
one more example which we recently faced while doing a valuation engagement. So we were valuing a company a couple of years back which manufactured shoes, and the clients of this company were schools, were kind of companies who kind of distributes it to schools or wholesalers. Now the COVID related impact which had most of the education or the learnings for the students were through visual or through virtual
Online
education. So
education.
that thought process of how the market is or the economic conditions are performing had to be then factored in the projection that, okay, the
Exactly.
company has a capacity of doing say 500 crores of business, but potentially since the schools are closed, there's no market where there is requirement of the kids to purchase the shoes. Potentially that
That will
utilization will
affect
never be there, and
right.
hence the revenue will have to be adjusted downwards to
Adjusted.
factor
Yes.
the market conditions.
Right. Right. Coming to next question. What challenges or limitations may arise in the valuation process and how can they be addressed?
Yeah, would you want
So
to take that?
yeah, I think uh, while I think the question is generic in terms of challenges that we face, but
Yes.
most
It will depend
most yeah,
case
the
to
most
case
common challenge that we face while doing evaluation is availability of information per se.
information. Right.
So that challenge which we face in terms of, okay, the projections are there but they do not kind of gel with the market trend. They are kind of assuming a very high growth. So the way we kind of try to address it is, maybe one is having a transparent discussion with the management that this is the revenue growth story of the industry, the data available in the public domain that say a particular industry is expected to grow at this rate. We have data both in terms of comparable companies which are listed, We also have data from the MCA now, where we can find private companies and try to see their margins. We look at the data and then try to kind of see how this aligns with the projections which the management have given, and try to make them understand that okay, you can reach a particular level, but any assumptions beyond that point looks extremely unrealistic. So that kind of challenges is general that we face, and we try to adjust the projections, or at least make them understand that okay, this is what a market participant would try to look at in terms of how the projections can be rationalized. So that's something which immediately stuck to my mind when you say what are the key challenges while doing a valuation engagement.
Okay, so coming to next question, what role do industry benchmarks and standards play in the valuation of businesses? So I think it's the same you have covered in this challenges, like,
Yes,
right?
yes.
She has
Very
already covered.
important,
Yes,
Anita ji, very, very important. We cannot
yes.
emphasize
We
the
cannot,
importance
yes.
of,
The
using
benchmarks
industry
and standards,
benchmarks.
right, right. Very true. How do investors use valuation metrics to make informed decisions in the stock market?
This is a very interesting question. Okay, so on a lighter note, let me say this, that valuers who have access to information about listed companies typically cannot transact because
Right.
there is UPSI
We cannot.
restrictions.
Yes,
And
yes.
the very nature of our work is like that, that while we can give valuations to such companies,
But we
we may
cannot
not be able to trade in them.
trade in
Our
them.
professional ethics
Right.
prohibit us from carrying out
Trading
these
this, right.
valuations.
Exactly.
But uh, but to to uh, but to say that how valuation is used in making investment decisions by retail investors, see, I would say that in addition to the fundamental technicals which are involved, particularly in markets like India, the public sentiment
Ah,
also
yes.
plays a huge role.
Huge role, right.
So
One
I would just
example,
leave it at that, I would think.
yeah, and I think one example, which again I would not like to name companies here, but there was a recent article which said that a particular pharma company was valued at say 50x EV/EBITDA multiple, whereas the rest of the comparable company doing similar business at similar growth stories were at 30-35 x multiple. This article kind of played very critical role, and I think material research reports followed on this pharma company. Why this growth story of this company is higher than that
Higher.
of peers. So potentially, in case if it was not, maybe then the price would have adjusted itself to kind of come to a 30-35x EBITDA multiple, or else the rest of the peer company, there would be a buying demand stating that okay, so one company have a similar growth story, is trading at 50x multiple, and then
Right.
there is other company available at a lower multiple. Let's kind of buy the stock which is at a lower multiple. So that's how kind of valuation metrics also play a role in investors making decision in terms of what to buy and what to sell, and this is purely public information.
Right. Are there any recent developments or trends in valuation methodologies?
So one thing which immediately stuck me. So we a recent portfolio valuation exercise very regularly. So there are IPVC guidelines under which this portfolio valuation gets done, and the IPVC guidelines had a recent update in December 22, which has now become effective. And this guidelines very specifically, it of course allows you to use market approach, cost approach, income approach. There is also requirement of a calibration approach, or a, when you are using that a price of a recent investment as a valuation benchmark, how that price of the recent investment calibrated to the market when the transaction happened, and how that calibration can be used going forward at a future valuation date. That is also something which we have started applying and considering while doing valuation engagements. So let me give you an
Example,
example. Sorry, go ahead, Apeksha.
go ahead, Jay. Complete your
Yeah.
example.
So let me give an example here. Say the company which I am valuing, that got funded at a 10x EV EBITDA multiple, and the comparable companies during that point of time was 8x. So there is a potential 20% premium which already my company has based on the growth story. When I'm valuing this company 1 year down the line, I say that the growth story still continues, and in case if the market multiple 1 year back was 8x and now it is 12x, I use 12x, and on that I continue applying a 20% premium, stating that okay, my company has the ability to grow faster at a much pace, and that qualitative factors which was there 1 year back should also align now. And then I use a 20% premium on 12x multiple to value my company. That's how I use a calibration approach along with the price of recent investment.
Yes, Apeksha ma'am, you were saying something.
I was alluding to the same thing,
Okay.
Anisa ji. So,
Okay. Yeah. So it was a very wonderful session, giving thorough insight of overview of valuations. So it's an excellent delivery by both our speakers with a very good presentation, and they have covered meaning of value, type of value, premise of value, then how to value, then even demands for valuations and key considerations, areas of valuation, and the single word value they have explained in such a detail that they have covered almost all this aspects, just for the single word value. And it was a really wonderful session. So I present my hearty vote of thanks on behalf of Valuation Standard Boards of ICAI. Thank you, Apeksha ji. Thank you, Jay.
Thank you.
thank you so very much. It is always a pleasure to present at professional forums like the ICI, and
Right.
we really thank you for this opportunity. And
Thank you, ma'am.
Anisa ji, one thing which I really believe, that knowledge has no boundaries,
Right.
and this is a
Exactly.
true collaboration
Right.
of our profession, where colleagues
Right.
in Nepal
Right.
Jay, your screen is shared, where our colleagues in Nepal have have had the opportunity to have a cross-border collaboration of knowledge.
Right.
I look forward to such opportunities more in the future.
Yeah. Thank you, madam. Thank you so much.
Thank you so much. Thank you for the
Thank you.
opportunity. Thank you.
Thank you.
Bye bye.
Have a nice day. Bye.
Bye. Bye. I welcome our second speaker for the day, CA Harmanjit Singh ji.
Good evening, ma'am.
Good evening, sir.
It is
And
an
the
honor
topic,
to
yeah, the topic covered will be valuation standards, which is a very important aspect for a registered valuer.
the topic given to me was the valuation process, reporting and documentation.
Okay.
So can I start?
Valuation reporting and documentation, right? And as per the valuation standards, before we start, sir, I'll just like to introduce you to our participants today. C. Harmanjit Singh ji is highly motivated and result-oriented CA, and he is a registered valuer with 13 plus years rich experience of progressive experience in accounts, finance, banking, audits. He has a proven track record of project implementation within overall company policy framework and in accordance with statutory and legal provisions. So he has an experience in accounting, finance, direct, indirect taxation, import and exports, commercial contracts, joint venture and acquisition agreements suitable for leading and developing a successful company account and finance and audit department. Is keen to find a challenging position with successful and ambitious company that offers opportunities. And he's worked with multinational and domestic companies of small, medium, and large segment, and liaised with different government departments for various corporate affairs, and has an experience in valuation of multiple listed and non-listed companies. So with this brief introduction, I request sir to start the session.
Ma'am, it's an honor to give a lecture on valuation to a body which is outside my country. I really feel very eager to share my presentation with you. As for the introduction, I am also an insolvency professional registered with IBBI. So with now, I am sharing my screen and starting my presentation. See, my topic is very simple, but it doesn't mean it is not critical. See, documentation is play a very critical role in any valuation. Once the valuation has been done, what remain is nothing but the documentation part. The only thing which can save your skin against any disciplinary committee, against any legal challenges, is the documentation which you possess. In any in any profession, be it a chartered accountant, company secretary, valuation, insolvency, documentation plays a very critical. So before going to the documentation, the first topic is the valuation process. Before going to the valuation process, one thing shall be clear in all of the participant. What is a valuation? What is the need of valuation? Why a valuation term come across? See, look, valuation is not a new concept. It is as long as old as the civilization. When the barter system is there, we value the things against a thing. When the monetary system come, we value the money with the things. Now, in this era of new unicorn is coming, which approximately $1 billion a company valuation is considered a unicorn. The interesting thing is that even though this startup is in a loss, still it can be a unicorn, isn't it? How? It is through a critical role of the valuer to analyze a company, whether it is a unicorn or how much it has worth from the future perspective, from the present perspective, from the government, legal, all the angles a valuer have to study and give a suitable valuation to a company, to a corporate, to a asset, to a process, to the thing which he or she is valuing. It is understand? Before starting the valuation process, one simple question, one simple clarification each valuer must have in his mind. What is intrinsic value? And how it is different from the fair market value or fair value? See, fair market value and fair value. First of all, understand what is fair value. Because in our standards, ICA standards, you will find a definition of fair value. So the next question come to you, then what is fair market value then? See, fair value is nothing but a value which an asset can get through an open market, through independent buyer and independent seller in an organized market. Okay, at a measurement date. This is a definition of a fair value. So what is fair market value? See, fair market value is also fair value. So what is the difference? The only difference fair value and fair market value possess is that fair value is accounting term and fair market value is a legal term. When we have to give a valuation for a legal purpose, we normally use fair market value. For example, if I have to give a valuation to the IBBI for a CRP process or a liquidation process or under Income Tax Act or under FEMA, we have to use fair market value. But if I have to give a valuation for the accounting 113 or any other accounting standards, we normally use the word fair value. Is it clear? So next question come to your mind, sir. What is the intrinsic value? We normally use the word intrinsic value multiple times in our valuation. But what is the definition of intrinsic value? My dear friends, as such, there is no such definition of intrinsic value. Isn't it strange? Isn't it strange that an intrinsic value which uses multiple times, but it does not have a definition? See, intrinsic value is a concept that any asset can be valued through any method, scientific methods. This is what intrinsic value. Suppose I have to value an asset, say land. I have to value land. It possesses some value. But what is a method I can use? Scientific or non-scientific method? In non-scientific method, what I will do hit and trial, auction. So that is not intrinsic value. But through some calculation techniques, through some judgment, prudence, if I getting a value of an asset, then it become an intrinsic value of that asset. As simple as it is, the difference between fair value, fair market value, and intrinsic value. So in the valuation process, in the valuation process? We value an asset through a comprehensive and a systematic approach. It can be an asset, it can be a business, it can be investment, or it can be any other thing what a valuer is doing a valuation. It is a journey, valuation process is a journey to arrive at the conclusion of the final value. What is a worth a business have? What is a worth an asset have? It gives through a proper valuation process. A valuation process, first of all, is not a hard and fast rule. It is not a rocket science, or it is not something which apply for all. Different type of valuation needs a different valuation process. Different type of assets can have a different process. So valuation process can be changed according to the type of valuation we are doing. But we will discuss over here a general process. A general process which a valuer should do while do a valuation. So that when a final valuation reports come in the hand of the stakeholders, they come to know how the valuation is done. Is it okay? It is understandable. Is it understandable valuation process? So next, we come to the next slide. In a general valuation process contain 3 steps. First of all, a valuer had to understand the past history of the business, of the asset, of the investment, or of the options for which he is doing the valuation. Second, mostly while doing the valuation, we apply the discounted cash flow method under the income approach. So forecasting of the future, I have to do the valuation, arrive a valuation at a present date, but the impact of the future can't be ignored. As well as the impact of the past can't be ignored, impact of the future can't be ignored. It is a prudence and the tools a valuer has to use to arrive the valuation at the current date, or the valuation date, or the measurement date. So at final, when all this data is available with the valuer, we come to the last step, which is evaluation. Valuation consider valuation report and final valuation. So getting the past work is basically the responsibility. First of all, it is a responsibility of the management of the business of the company to provide you all the required data. But a valuer should not only depend upon the management of the company, he has to use his own prudence, judgment, tools from anything which is required to do evaluation. A valuer has to keep his hand before doing the proper valuation. So information collection of data research, what kind of data points a valuer need? Mostly doing the valuation, typically a valuer need a financial statement, a cash flow statement, income statement, balance sheet, and the financial matrices. These are the basic documents a valuer should take before doing the valuation. However, we will cover the point where there are constraints over the data availability. We all know what is a financial statement, what is the cash flow statement, income statement, balance sheet, and other relevant financial matrices. But while doing the valuation, what is happening? Try to understand. Mostly we do the valuation within the year. That is not. That is after the financial statement has become audited. Now, a valuer, first of all, he is not an auditor. He is doing the valuation. So a management has to give the valuer the financial available statement or other financial matrices which is required to do the valuation. But my dear friends, a valuer should do a basic due diligence, a caution. He can caution the financial statement which he received from the management. Is it clear? Now the second point is industry and economy analysis. See, valuer is not only dependent upon the managerial data which he received to do evaluation. Other than the data which he received, the financial statement or the cash flow statement which he received, he has to see the industrial trend as well. Whether the industry is viable or it is facing some serious concern, or is there any government obligations there, or any risk factor, any supply chain dynamics is there. See, try to understand the supply chain dynamics first of all. How it is critical, how this industrial and economic analysis play a critical role in valuing anything or any businesses. See, recently, what we see in overall in the economy, European Union and Europe play a very important role. But suddenly, in past years, they are facing some supply chain dynamics in terms of petroleum or energy utilizations. So, does it impact the valuation of that economy? The answer is yes. It impacts the valuation. Suddenly, you will see that their ratings become downgraded. Recently, the China economy rating become downgraded by the Finch, and the Indian economy rating has been increased. So these industrial and economic play a very critical and important role to evaluation. So once industrial economic analysis database is available, it is very become easy to for to do a proper valuation. Second, economic analysis. See, first of all, these two analyses, economy and industrial and economic analysis, a valuer has general hold on this analysis. He does not require to do a in-depth analysis as far. Generally, the data which is required to do the company valuation should be with them or her. So in economic analysis, we have to see what is the GDP growth of that particular country. What are the inflation rates, interest rates, consumer spendings, government policies, and economic condition. One by one, GDP growth plays a very critical role in arriving at the growth rate of the growth rate in the post-perpetual years in a discounted cash flow. How we assess the growth rate of a business, GDP and inflation rates play a very critical role. How interest rates play a critical role. See, while arriving at the risk-free rate of interest of any economy, I have to check the interest rate of the government policies. Generally, in India, what normally I use is a 10-year government bond yield loan for risk-free rates. Is it clear? Government policies play a critical role. See, generally, if you see before liberalization, the government policy was different. But after liberalization, the government policy played in very huge impact on evaluation of our economy. So within a simple one day decision, change the valuation perspective of an business or economy. Global economic conditions, if globally every supply chain is there is no war is happening, there is a nothing seriousness as much as scenes. So obviously the valuation ratings or valuation or the rating of a business of a country increasing with that aspects. Clear? Get a better understanding of past work include critical role of historical analysis of any business. Before doing the historical analysis, I can never do a proper valuation. However, startup valuation requires something different tools, which other than startup, I can say that I have to do a historical valuation of any business. Suppose I am doing a valuation of an IT company. Suppose I am doing a valuation of manufacturing company. First of all, I have to understand the basic businesses. What kind of business the manufacturing unit is doing? Whether they are producing through open market channel, through OEM, or through job work. What are the kind of manufacturing they are doing and how they are doing? Secondly, I have to check what is the availability of the raw material in the past years, what the manufacturing unit is required. Overall, I have to see from the organizational structure, from the past dividend rate. I have to check everything to understand the business. Secondly, I have to check the regulatory framework for the industry. In India specifically, if I say, if I do a domestic company valuation, I have to use a different tools. But if I have to do a valuation of a 100% EOU or an SEZ units, I have to use a different tools. So the regulatory framework change the valuation method and evaluation approaches for doing the evaluations. Second, understand the value drivers. So what is the value drivers? A value drivers is nothing, is what is the core principle of core factors to arrive that valuation. Suppose I have to I have to analyze the cash flow of a company, and they at most in their 100% capital utilization, they can manufacture 2 lakh metric ton of a cements. But in the cash flow, if I say they are giving me that the company can produce 4 lakh metric ton of cements in a year. So I will not accept that facts, because how can a company go beyond its 100% capacity utilization? So value drivers, a valuer have to check the value drivers and analysis whether these valuation come within the scope of value drivers or not. Fourth and fifth are the accounting analysis and accounting policy reviews. See, we all are chartered accountants or we have accounting field knowledge. A valuer has to see that while doing the historical analysis, is there any regular changes in the valuation policies, or is there consistently uh, they have the consistent valuation policies with the company? See, it will reflect a minute change we have to do while doing the valuation with the consistency or regular changes in the valuation policies. Length of the financial histories. See, length of the financial history play a very critical role while doing the valuation of the ABC project or the CRP or under the liquidation. Mostly, the valuer is not sufficiently equipped with the proper valuation history which is required, because the company has no data with them, and the regional professional or the RP or the management has no data with them. Adjustment to the financial statements. See, adjustment to the financial statement, try to understand. However, overall, a financial statement is audited by a particular chartered accountant accounting of the relevant laws. But from the financial perspective, we have to do certain adjustment to the financial statements. We have to check whether there are non-core investment is there, or is there any tax amortization benefit I can check from the financial statements. So this kind of adjustment I have to do. Is there any contingent liability which is due and which can be paid? In the eighth point, I have to do the asset and liability analysis, including contingent assets and contingent liability. See, this contingent assets and contingent liability can change the valuation to and impact the valuation multiple times. Suppose there is a legal case is pending against a company which is shown in the contingent liability, but if on a certain due diligence, a valuer come to a conclusion and in the opinion of the valuer that this contingent liability shall impact the valuer valuation, then he have to give the impact of that contingent liability in the valuation will drastically reduce the valuation, equity valuation of that company. So you cannot ignore the contingent liabilities. However, on the concept of conservatism, you can ignore the contingent assets, but not the contingent liabilities. Income and expense analysis. See, while doing the future cash flow, I have to check the historical cash flows, the historical income growth rate, the historical expenses growth rate. What is happening in one valuation? There is a loss is occurring on year-to-year basis from the last 3 years of a company. However, in the future cash flows, the company is showing a rapid growth in the cash flows. So being a valuer, I have to check whether these value drivers give the true and fair view or not. Or what is the reason of the previous losses and what is the reason of the future profits. Understand? And the financial analysis, obviously we have to do the cash flow analysis, working capital analysis, and this kind of analysis in the valuation process. Is it clear? In further, we have to do some various other analysis as well. See, being a valuer, I am again saying I will not go dig down and deep in this kind of ratio or trend analysis. However, a basic analysis should be there with me. There shall not be any drastical red signal in this kind of ratio analysis. In ratio analysis, I have to do the profitability ratio analysis, return on equity analysis, return on asset, gross margin, net margin ratio, current ratio, quick ratio, debt to equity inventory ratio, price to earning and price to book ratio. P ratio and price to book ratios are very critical while doing the valuation of a listed companies. If the P and PB ratios are different from the peer groups or the peer companies, then we have to go further dig down what the reason of that drastic changes. Trend analysis. We have to check the trend of the earnings, trend of the growth, gross margins, net margins, and we shall compare those trends with our comparable peer groups. And whether they are give a justification of the industrial benchmark or not. Most of the time you will see that trend analysis show in similarity with the industrial benchmark, but in some cases there can be changes and you should be suspicion and do a further finding out the reason of that trend changes. Okay. Thereafter, cash flow analysis. Cash flow analysis generally is to be done in almost all of the evaluation processes: operating cash flow, free cash flow, capital expenditure planning, working capital management, and sustainability of dividends. We will see cash flow analysis in further presentation in ahead of my presentation. Strategy analysis. Generally, we have to see the in big corporates, we have to do the strategy analysis as well. What kind of market share target of the company? Is there any merger and acquisition targets? Strategic expansions of the company? What are the target consumer of that segment? What are the risk mitigation strategy of the company? See, this kind of analysis normally do when we do the big corporates or the most of the time listed companies. This kind of analysis should be there. Company risk analysis. See, what is happening while doing the valuation of generally fixed assets? We have to check whether the company risk, what is the company risk analysis? Suppose I'm doing the valuation of a plant and machinery and that company doesn't have the insurance coverage there. So does it impact the valuation? obviously it will impact the valuation. What are the currency exchange rates risk, technology risk, whether that particular company is working on the obsolete technology or they are cop up with the new technology day by day. Understand? So before doing the historical analysis, what I will next process is forecasting the future. What is forecasting the future? And whose responsibility to forecast the future, first of all? Forecasting the future is the responsibility of the management, first of all. But being a valuer, I will do my due diligence on that forecasting. Understand? Providing the future cash flow is the responsibility of the management. But how that forecasting is done and doing the due diligence is also I shared equal responsibility with the management. So if my valuation report is become challengeable on the basis of cash flows, then I have my proper database with me that what kind of due diligence I have done, why I accept that particular cash flows from the management. It is very critical if your report becomes challenged in the court of law or in front of your regulator. Your due diligence, your analysis will save you, unless, my dear friends, it become a very critical challenge in the valuation process. So what, first of all, the for future cash flows shall be structured forecast. It involves most of the process which we have already discussed on the historical analysis, we have to apply in the future cash flow as well. Doing identification of the key valuation drivers, sensitivity analysis, trend analysis, normalization of the data, probability of the weightage, consistency across the model. Consistency across the model. In doing, I share my experience in one valuation. For the first 3 years of the cash flows, there were consistently growth rate. But in the next 2 years, the management provided me a huge change in the growth rate in that particular model. And the management doesn't have that, but that the answer to the question why they are showing the huge growth rate in that particular model. So being a valuer, what I will do, I will normalize the cash flows provided by the management as the sensible manner, structured manner, and the prudence I will apply on that. Understand? Income statement, the forecasting the future include below forecastings, income statement forecasting. Income statement forecasting is nothing but what I am earning in the future. What are my sales? What are my operating incomes? How will I arrive at that particular operating my operating incomes? And what are the justification are there to justify the figures which are I'm getting from my future cash flows? It include the sales projections, product and service specific revenue, different same business segment, same business at different segments, and different segment at different sale targets, and that different sale segment provide me different kind of revenues. Some shows a different growth rates, different segment can show me different growth rates. So we will keep in mind while doing the valuation of a big corporates. Customer growth rate, gross margin analysis, fixed and variable expenses. So normally in the future cash flow, I will do the pre-money valuation. So the most of the time the fixed expenses are generally doesn't changes. However, there you will see a change in the variable expenses. Interest expenses. Interest expenses are very critical value while getting at the enterprise value or in a particular valuation. It impacts the valuation in multiple parameters while getting the discounted, while arriving the equity value. So these interest expenses play a very critical role. And if the interest expenses is not correct, my dear friends, your valuation can never be correct. Effective tax rates, adjustment of anomalies, best and worst case scenario. The next step in future, forecasting the future is the balance sheet forecast. The balance sheet forecast normally include the working capital changes and fixed asset changes. These two are play a very critical role in the valuation process. Balance sheet provides snapshot of a company asset and liability, equity at a specific moment. And if the valuation is to be correct, the balance sheet forecasting has to be give me precision point accuracy. Here, nominal percentage changes in my working capital can drastically change my valuation. Okay. So it involves asset forecasting, what kind of current asset, fixed asset, intangible asset, liability forecasting, current liability, long-term debt, deferred tax liabilities, working capital changes, debt maturities, planned or unplanned capex, also dividend and payments. See, in all these forecasting, I will give you a hint of a deferred tax liabilities. See, deferred tax liabilities forecasting become very critical. First of all, it is a below the line items. It doesn't change my working capital. But while calculating the minimum alternate tax, because that comes under the pure deferred tax now, I will get the tax amount. I will have to get the tax amortization benefit. So the MAT, I don't know. I'm not sure whether MAT is applicable in Nepal or not. But in India, there's a minimum alternate tax scenario, and that MAT is heavily influenced my valuation in terms of tax amortization benefit. Okay. In the next step, there is a cash flow forecasting. After doing the profit and loss forecasting or income forecasting, second is balance sheet forecasting. My favorite part comes, that is cash flow forecasting. A valuer, while doing the discounted cash flow or comparable company cash flow, the cash flow forecasting is the responsibility of the valuer. He has to do the simple valuation tool and come across operating cash flow, free cash flow, net cash flow projections, and integrate it with the different valuation models, that is discounted cash flow or comparable company analysis method. I hope you all know what is discounted cash flow and a comparable company analysis. Discounted cash flow come under the income method, CCA come under the market method of the valuation. Okay. Market approach, income approach and market approach. The third and the final step in my valuation process is doing the valuation. See, at any given point of time, if you are have done a pinpoint, do the valuation with pinpoint accuracy, my dear friends. But if your report, there are error in the report, what your operator require from you. In my case, my operator is IBBI. What your operator regulator require from you. Your report is not up to the mark. No one can save you from the disciplinary actions. Your report should be clear cut. However, you can use various assumptions, various caveat, various disclaimer while the valuation, but that particular assumptions, caveat or disclaimer should be reflect in your report and have a very strong base. Write down all these points. Previous valuation process, you can generally create a tool or Excel tool or other tools available in the market. But when it comes to the preparation of the report, you are only responsible while preparing the report. So these points are very critical. Write it down if you can, because while doing the valuation report, these points should be there. First of all, your valuation report is considered valid for the valuation date only. These are the assumptions. All statements given present represent a true and fair view. This true and fair view, once we start the accounting process, is with us and always with us. Not true and correct view, not partially true and partially fair view. It's always true and fair. Opinion, your valuation report should have opinion, conclusion, decision represented by the valuer in term of valuation are unbiased and fair. Unbiased and fair is a very critical concept in terms of integrity and independence of the valuer. And valuer should never be biased in doing the valuation. There is no personal interest in the asset, property, intangibles, intellectual right, etc. by the valuer. See, it should be material. Understand? We have relied on the information provided by the management for the purpose of valuation, but you have to do a basic due diligence what the database has been provided by the management. Public information and industry statistical information have been obtained from the source believed to be reliable. However, no representation is made as to the accuracy or completeness of such information and has performed no procedure to corroborate that information. You can use the public information, but that should be from some authentic resources. See, in India, we have very authentic resources of BSE and in terms of NSE because our listed companies have to get registered with this two prominent institute NSE or BSE. So normally we use the public data from this kind of public information utilities which are available with us. Or we can use the MCA data which are very reliable in India. Do not provide assurance on the achievability of the result forecasted by the company because events and circumstances frequently do not occur as expected. See, it is not the valuer's responsibility to achieve that result. Valuer had done this basic due diligence and satisfied himself that these are the achievable results. But actual result may be different. Maybe more than the expected, maybe less than the expected, maybe even the company can go to the dissolution after 1 year of the valuation, but it is not the responsibility of the valuer. Okay. If an intangible asset is not able to generate benefit for the firm and the benefit cannot be measured reliably, then it treated as an expenditure, not an asset. Generally, most of the cases, intangible assets are the assets. But if the valuer they have doubtful or it is sure that this can be treated as expenditure, then it can be treated as expenditure. But most of the cases, intangible assets should be treated as asset of the company. The legal background, financial aspect, tax matter regarding the business valuation, description of principle used in the business valuation. These two the general terms should be incorporated in the report. So next process in the valuation, my dear friends, come to the cost of capital or the discount rate. See, do not rely on the discount rates available on the internet or any books. You have to calculate the discount rate. It is my personal experience, is my personal request to you all that you must calculate the discount rate through some settled models, whether it is CAPM, whether it is Gordon growth model, or any model, the discount rate should be reliable and calculated discount rate. You have some basics to arriving at that particular discount rate. In most of the cases, the discount rate is the expected return, which is normally the weighted average cost of capital. And for the determining the weighted average cost of capital, we do the cost of debt and cost of equity. We all know what is the cost of debt. It is the interest rate minus the tax benefit which I receive. And for as far as the equity, my favorite model is the CAPM model. However, there are other models available in the available for valuation, that is important growth or any other model. But my favorite is the CAPM model. What is the CAPM model for driving the equity cost of capital? That is risk-free rate plus beta multiplied by market risk premium. We will discuss on each item separately. Risk-free return. Say risk-free return for any country is different. It can be same, but most of the time it's different. The RFR in India is different than RFR in Nepal, RF in Nepal is different than the RF in America. RF in America is different from RF in Australia, Canada, Dubai, etc. So first of all, I have to see what is the risk-free rate in my jurisdiction or my area for which I am doing the valuation. It is mostly the government bond rate, most of the time. But if a government bond rate shows a different picture, then valuer can use his prudence. But in our settled economy like India, we rely on the government bond rates. Second is beta. Beta is very critical to study and very critical to arrive manually by the value. Not we can't use the beta available on the NSE side, BSE side, or Shri Ashwad, the modern database. No, we have to separately calculate the beta for my company in each case through some comparable companies. If my company is not listed, obviously I have to go through some comparable company arriving at the beta multiples or to come at my levered or unlevered beta. The calculation of beta is a different exercise, but you have to learn this and calculation of beta while doing the valuation. My friends, don't rely on the beta available on the internet or on any book or study. You have to calculate separately for a unlisted company. Beta is nothing but the volatility related to the market as a whole. See how my company react to the that particular changes in the market. This is what the beta is. It can have a direct relationship with the economy or the indirect relationship with the market. You have to check before doing the valuation. Second is a market risk premium. Market risk premium is nothing but a difference between the expected return and the RFR. Basically, expected return is what my market is giving to me, and the risk-free rate is a government bond rate. So expected return, we have to calculate separately for each case. Okay, we cannot assume or we cannot say that this is my expected return. We have very strong base for arriving at the expected return. In India, we normally use the return given by the Sensex or the given by the Nifty. Okay, and that's it for BSC. Now the valuation models. These are the three approaches what each valuer has to apply in each cases. However, if there are constraints on applying the approaches, then we have some strong base with us for not applying that particular approach. Okay, we will discuss each approach, a brief discussion on each approach. Income approach, income will determine the value of the business by assessing its future income generating potentials. Understand, mostly we have two methods with us in income approach. However, there are other methods available, but the core methods are discounted cash flow and the capital equalization method. My favorite is discounted cash flow. I most of the time apply the discounted cash flow because it's the most reliable method. Market approach. Market approach is as its term says, we see what my comparables are doing, what my peer groups are doing. I have to check that whether what kind of value they can achieve doing the same things. So doing some permutation combination, I achieve the valuation of my business as well. In this, there are two prominent methods, comparable company method or precedent transaction analysis, or sometimes it is called CCQ method as well. My favorite is comparable company method because most of the time we have with us the financial data available with me of other peer groups. However, the quantitative data for applying the PTM method, most of the time their data is not available through some prominent or good resources. In asset approach again, once we come to the asset approach is determine the value of the business by assessing the value of its underlying assets. We have to separately analyze the value separately of each assets and arriving at the value of the particular business through its network. See, in asset approach as also, my valuation standard doesn't debar me from using the historical value of the asset. However, a valuer should try to get if he is applying the asset approach, he should try to get the fair value of each asset separately and each liability as well separately for giving the net asset value of that particular company or particular business. However, he can use the statistical method if you have very strong evidence with him that this method can give a fair value in much good way than the evaluating each asset separately. In these two methods, asset-based valuation and liquidation valuation, I have to arrive. Most of these two valuation I have to give in the most of the time these two valuation has to be given in case of the valuing of a company which is under the CIP process or going through a liquidation process. Understand? Arriving at the fair final value, see, arriving at the final value after getting all these database with me, after assessing the discounted cash, discounted DCM method, CCM, or arriving the value at the net asset value approach, I have to come to the final value. See, this is nothing but a culmination of the involved synthesization and the findings from various valuation approaches. Each approach contributes unique insight, and I have to give a particular weight to the different approach I have used. See, understand first of all, giving a weight is also a very tough exercise. What weight has to be given to the different approaches is the value has to use very prudent method to giving the weight to the different approaches. Now, preparation of the valuation report. Most we have discussed the key ingredients in the valuation report in my previous slides. That key assumptions and the limiting conditions we have to see before preparing the valuation report. Now, while preparing the valuation report, a valuer has minimum few things which should be there in the valuation report as per the valuation standards and the valuation rules. First of all, the background on the information on the asset or the business being valued. If I am doing the valuation of particular business, I have try to understand from the perspective of the stakeholder of the valuation report. A stakeholder should be equipped with your valuation report should give a clear-cut picture of your report in front of the stakeholder or the final user of the report. You have to give the brief background of the information of the business. It should be brief. It should not be lengthy or detailed. You have to give all the things, but it should be sufficient enough to understand what is the business of the company. The purpose of valuation and the binding authority. In most of the cases, it is the board of directors or the audit committee who is appointing the valuer. However, if a company is under the CIRP process or the liquidation process or the similar process in that, then mostly the registered professional or the liquidator who is appointing. However, in some cases, the honorable uh, court or the court or honorable judges appoint the valuer in some cases to arrive the particular valuation. The purpose of valuation should be clear-cut mentioned in the report. In India, we do valuation for different purposes like for Companies Act, for FEMA, for SEBI, for CIRP, for liquidation, for banking industry. There are various reasons, but the purpose should be specified in the valuation. Why you are doing the valuation? The purpose should not be vague. It should be specific. It should be specific. The identity of the valuer. Being a valuer, my identity is I am registered with the IBBI. However, if I am also a chartered accountant, I can give a report if it is not required by a registered valuer. As a capacity of chartered accountant, I can give. In that case, my identity become a chartered accountant instead of registered valuer. But if I am giving the valuation report as a capacity of a registered valuer, then it should be a registered value. And the uses of other experts involved in the valuation. See, sometimes what is happening? practically understand for doing a valuation of a particular business, sometimes I have to I have to take the help of some legal expert, some industry expert, some expert of that particular area. It depends what kind of business or what kind of asset I being valued. But the the identity of that particular expert should be my boundary. And being a primary my responsibility or the work of that expert also. That's what my valuation standard says. The disclosure of value and interest or conflict, if any. See, in my view, as far as I know the valuation rules or valuation standards, if there any kind of interest or conflict of interest, a valuer should not accept that particular assignment. They should give us the assignment because the basic fundamental of my valuation, that is independence, is hampered with that conflict of interest. If there is conflict of interest and it can materially impact your biasness in that particular report, you should not do that valuation. The date of appointment or valuation date and date of report. It can be different, it always be different, it can be same. Most of the time it is different. My date of appointment is different, valuation date and date of report is different. See, valuation date is the date on that is a measurement date for which I am the asset being valued. See, suppose I am doing the valuation of a company for a year 2012, but I am doing the valuation as in 2023. Can I do that? Yes, I can do that. I can do the valuation for the past. Most of the time, I do the valuation of the past period. However, the date of report is present. Clear, fundamentally clear. Inspection and investigation undertaken, if any. Most of the time, I investigate through some sources, that is MCA, Prop 42, or some other reliable informative centers. Nature of source of information used or relied upon. Nature and source of information is mostly what management provides you, what kind of database management given to you, what the public data you have used. All these things should be imbibed in your report, clear cut with clear procedure. What is the procedure updated in carrying out the valuation and valuation standard followed? It is very critical in India. If you do not mention the valuation standard, whether it is international valuation or ICA valuation or any other certified bodies standards, see, disciplinary action shall be initiated against you, and no one can save you. So, your report should imbibe itself that what kind of valuation standard you have applied, what is the procedure you have adopted. We have detailed discussed the process in the evaluation. The restriction on the use of report. In every case, in my case, most of the time, or in most of the cases, each valuer has to restrict its report to the purpose of the valuation. If I am giving my valuation report for Companies Act, I restrict my use of valuation report for that particular section. You can't say to whomsoever it may concern. You can never say that because you never know what can be the misuse your report can misuse of your report. Your report should be specific to the purpose of the valuation. Understand? However, in the purpose itself, if you give particular restriction on the uses, you can also imbibe in your report. Major factors that were taken into account during the evaluation. The conclusion, obviously, conclusion nothing but opinion you have formed and what the value you have given. Now the I point in India, IBBI given a detailed guidance on the caveat limitation and disclaimer can be used or cannot be used by the registered valuer. See, IBBI is very much fundamentally clear what a valuer report should speak. How to prepare the valuation report, what the uses of the valuation report. My operator is very much clear, regulator is very much clear about that. And each valuer should have clarity in his mind, what is the expectation of the regulator from a registered valuer. Okay. Now come to the second discussion. It shall be very short topic. Report is short but not immaterial. It is very valuable topic, that is documentation. Documentation save a skin of a valuer at each point when there is some conflict arises. If a valuer is proper equipped with the documentation, 90% of chances are there that the valuer can be saved from some disciplinary actions. But if the documentation is poor, no one can save you. So my standard is very much clear how to deal with the reporting and documentation. The standard ICA standard valuation standard 202 give us the minimum content of the valuation report, which we have already discussed. Basis for preparation of the valuation report, most of things we have covered. Basis of maintaining sufficient and appropriate documentation, we will discuss in this slide. So documentation, what is documentation? Documentation is nothing but a records. In general term, the records, what records you have gathered to do a valuation. Understand? It contains evidence. It contains the Excel files, the management representations, management declarations, everything what you have taken to do the valuation. See, the maintenance of documents depend to the regulator to regulator, to the country to country. But in my particular view, the documentation shall be available with the registered valuer throughout the lifetime. You never know when your valuation report become a challenge in the court of law. And in the court of law, there is no timeline. You have to produce the documentation to the honorable judges whenever they demand. So, however, my valuation standard required 8 years. MCA, my companies are required 3 years, but it should be there for lifetime. A valuer shall maintain the documentation which provide the sufficient and appropriate records on the basis of the valuation and evidence that the valuation assignment was planned, performed according to the ICA valuation standard or other valuation standard or applicable legal and regulatory requirement, as the case may be. Documentation shall be prepared at time of valuation assignment. See, my valuation standard or ICA valuation standard very much clear that your documentation shall be pre-valuation. You can't say that, see, I have signed the report, after that I gather the valuation document. No, your documentation shall be pre-signing of the report. Understand? A value shall retain the information obtained not shorter than 8 years from the date of valuation report. It is a valuation standard. However, companies that give a 3-year time. Minimum documentation letter. See, write it down if you can. These become the Bible of your valuation report. Bible of documentation. At least these documentation should be there while doing the evaluation. And after 8 years, I say through lifetime, these documents should be there with you. My evaluation standard says, ICA evaluation standard says that can be in a soft copy or in a hard copy. However, I generally say that you have to keep in both forms, in hard copy as well as soft copy. The first document is the appointment letter or the engagement letter. See, this is a very critical document in the court of law. If you don't have the appointment letter, you can't do the evaluation of any company. You have proper board resolution approved. There should be a proper board or resolution, or the appointment through the audit committee should be there. Understand? The tabulation of the data obtained during the course of evaluation. The tabulation data is a basically Excel format or the Word format of the database. What are the data with you? Working undertaken to drive the evaluation. In most of the cases, discounted cash flow working, and CCM working, comparative company method working shall be with you in but in my case I imbibe those working in the valuation report as an example in each cases. So valuation report consists this working also. Copies of the relevant circular extent of legal provisions, most of the cases RBI regulations and MBB circulars, or in our country MCA regulation, MCA circulars. In most of the cases, however, I have to equipped with the SABI regulations or the FEMA regulation as well, and another law regulation, whichever is there to value the particular business. The basis, approaches, and method or combination thereof to use rhyme at the valuation. See, these documentation is to be mapped in the report. So if you have the signed copy of the report, please serve the purpose. Assumption, a change in which may materially affect the value. See, this is very much critical because assumptions or a materiality I will imbibe in the report, and each value shall imbibe in the report itself. That serve the purpose of the documentation. Copy of the signed valuation report. I say valuation standard very much clear. You should have a copy of signed valuation report with you every time. Management, client presentation letter, or such communication received, if any, on the basis of which you arrive at the conclusion of the valuation. Evaluation documentation is not limited to a record prepared by the valuer, but may include appropriate records such as minutes of the meeting, report issued by other expert, other independent industry sector, or other data provided to the valuer by the client, if any. Clear retention of document. I clarify you in India, we have minimum 8 years as evaluation standard and 3 year by the Companies Act. Sorry, 3 year by the Registered Valuation Rules, Companies Act, and 8 year evaluation standard. But I generally retain the document for the lifetime. If you are clear with the previous my two topics, valuation process and the valuation documentation and retention, this importance of document is nothing but a, you can say, general benefit of the documentations. Document is of paramount importance in the valuation process for several reasons. It serves the various stakeholders involved in the valuation. Key highlights are transparency and credibility. It shows, documentation shows that the valuation is done through some transparent and credible methods. It is not a vague report or a vague valuation. Second, very much critical, audit trail. You generate some audit trail through the documentation. If your valuation report challenges the court of law, these audit trails help you to save you from the legal proceedings. Legal and regulatory compliances. In India, it is clearly that by my regulator, the legal and regulatory compliance should be there in form of documentation. Facilities review, peer analysis. Facility review and peer analysis. See, these are nothing but provide a very accurate review process. See, once you do the evaluation, you can review your evaluation multiple times through documentation only. If you don't have proper documentation, you doing the next evaluation can be again go through again those challenges, but it increase your confidence in you if you have proper documentation with you. You can cross check the documents you have taken for the next evaluation as well. Communication of assumption and limitations. Again, documentation provides you the basis for the assumption you have taken and how you convey those assumption and limitation to the stakeholder in form of evaluation report. Future reference and update. See, we are in the constant regulatory world. Today we have to do the evaluation as per the some other method. Tomorrow I have to do the evaluation some other methods. Recently in India, there is a drastic shift in the evaluation of income tax as per 11 UA. The income tax department has changed the whole rule through which the income tax valuation is to be done. So each documentation of the previous work gives you a base for the future references. Understand? Dispute resolution, obviously, if you have a good documentation, you're there are very much less chances that you come across any dispute. Clear cut documentation is the core of any valuation exercise. Training and knowledge transfer. See, in India, it is a discussion that a separate valuation institute be created by the government, and you have to go through some compulsory training under a registered valuer. So if you have to give your training to the your apprenticeship or the articles, you himself must be come with good documentation. In summary, documentation is the cornerstone and robust defensive valuation process is contributed reliability, transparency, and credibility of the valuation. With this, my presentation is over. This is CA Harman saying with you. I'm open to any query and question. Dimple ma'am, may I know, is there any queries with you or questions with you?
Sure, sir. Tanisha ma'am will ask questions.
You can ask the questions. Anisa ma'am, Nisa ma'am,
Uh, so the first question is, does having an interest prohibits the valuer from taking up the valuation assignment?
see, having an interest is a directly impact the independence of the valuer. If I have interest in any asset or a business, I there are chances my valuation report is unbiased, is not is full of biases. So obviously a valuer should not do a valuation if he or she has an interest in particular business or an asset.
So the next question is, sometimes the regulators do not agree with the valuation report. In such cases, what is the valuer's responsibility?
And responsibility is to follow the regulator. You have to follow the regulation and the rules created by your valuator, your regulator. If the regulator is not agree with your valuation style or valuation process, you have to change your valuation as per the regulation.
Thank you, sir. So the next question is, can a professional holding equity shares of a listed company, 10 lakhs value approx, do valuation for any transaction that company undertaking?
See, this question have two answers. First is yes, second is no. First of all, if you have interest, no matter how material it is, try to avoid to do the valuation. But as far as interest is concerned, if you have a material interest, then then surely you cannot do the valuation. So if there is a concept of materiality, if you have material interest, you cannot do the valuation. However, if you are nominal or immaterial in nature, then yes, you can do the valuation.
Thank you, sir. So the next question is, under whose review valuation of inventory fall, SFA or plant and machinery?
Prima facie, it is SFA. Inventory valuation is a prerogative of the security or financial asset valuer. However, if my engagement letter clearly spelled out that this particular valuation should be done by the some other valuer, then I have to go through the engagement letter. But if there is nothing is there in the engagement letter, then yes, SFA is my responsibility.
The next question is if valuation is required to check the value per share only for the information of the proposed buyer who is interested to buy the business, whether there is a need that valuer should be registered.
Registered valuer, I guess.
Yes.
I guess, see, try to understand if valuation can be done by anyone. It is
Right.
not
No.
possible that, see, valuation can be done by anyone. However, if a particular statute or particular law required that this particular valuation should be done by registered valuer, then yes, that should be from the registered valuer. Otherwise, valuation exercise is open to all. It can be done by anyone.
Okay. The next question is whether valuer can rely on the disclosure on pending litigations of the entity under valuation only on the basis of MRL, that is management representation letter. What can be the cross check if valuer interested to dig deeper?
First of all, try to understand, being a valuer, I am not doing that audit of that particular business or particular corporate in that valuation process. I have to rely on the management. But if I have any doubt that these information provided by the management had some red flags, whether it is regarding the litigation or any other information provided by the management, yes, I can dig down. I have to dig down. There are various tools in form of Pro 42, in form of litigation. You can check the litigation pending in the High Court, in the lower court, district court, NCLT, anywhere. Yes, you can if you see some red flags.
Okay, the next question is, sometimes past data or precedent are not available, which can materially affect valuation. So how to deal such cases?
I will not do the valuation if something which is material is not available with me. Whether it is a past
Right.
data or the future cash flow,
Yes.
a valuer cannot save itself from the concept of materiality. If material information is not available, simply deny that valuation.
Right. I think that's all with the questions which we have. So it was a wonderful session, a very good presentation, and you have explained the valuation process, documentation of the same, and the important things from the perspective of valuation as a valuer. And I'm sure it has been very useful and enlightened all the participants. And and it has benefited all the participants. So I present a hearty vote of thanks on behalf of team of Valuation Standard Board of ICAI and all the participants. Thank you. C.R. Manjit Singh ji. With this, we come to end of today's session. Thank you. Thank you so much.